It's time for a technical look ahead now at the markets. Joining us now is Ron William, independent market strategist. Hi, Ron.
Hi there.
Last time we spoke, you were in Switzerland. I was here, so it's very nice to have you face to face for a change.
Thank you. It's a pleasure to be here.
Well, let's talk about the jobs market, and in particular off the back of the U.S. non-farm payroll data, which came in a little bit weaker than anticipated. We were looking for a figure of 90,000. We got a figure of 80,000 for the month of June. The jobless rate, they're remaining steady at 8.2%. But where are we going according to the charts?
Well, according to the charts, we can look at key levels and just changes in momentum and correlations in the market just to get a gauge of what might be happening. And if we do that on US non-farm payroll, what we see is that there has been deceleration of momentum since the beginning of this year. So month on month, we generally have seen weaker than expected US non-farm payrolls. And it has been within a range. The upper part of that range is around 250K and the lower part around 54K. Now, I think the 54K level we're clearly closer to that. And that has been ever since we had a exhaustion signal, a DeMark exhaustion signal appear early in January. So I think 54K is the level to watch over the next few months ahead, and time will tell.
Mm-hmm. So nothing is kind of indicating whether we are in a downward channel now, or whether we potentially are looking at some stability creeping into the jobs picture.
I think it's too early to tell. Last month was probably a good downside signal, but we need to get a confirmation beneath 54K to suggest a potential breakdown in the numbers into negative territory.
Okay. And that is a DeMark exhaustion signal as opposed to a Denmark exhaustion signal.
Absolutely,
yeah.
yes.
And just explain once again the DeMark exhaustion signal. What does that mean?
Sure, it's an indicator developed by a very well-known investor called Tom DeMark, and it just measures exhaustion in momentum. It can be used in the financial market, but also just any data set that has momentum changes.
Okay, because some of us Danish people are a little bit sensitive to the other one.
Yes, of course.
Let's move on. Let's talk about the euro dollar as well. It's been pretty well bid this week, despite the fact that we've had quite a bit of weakness filtering through from the various economic data. We had the PMIs, which were pretty atrocious also for Germany, and of course also we had central bank action across the board.
Yes, I mean, I think generally speaking, most of the bounces or the recoveries that we've seen in euro dollar have been short-lived, and that's very much reflected the psychology in the market that everyone is still euro bearish in currency terms, and maybe the ECB central bank easing recently just added further overhang to the downside. I think today's numbers haven't really nudged euro dollar much. But we are close to the 2012 lows, and probably more importantly than that, as you can see on the chart there, 121.20 is the key level to keep an eye on. That basically marks euro-dollar losing half of what it would have made from the 2000 bull market. So it's a key psychological juncture.
Okay. And then I'm thinking what that potentially could do to gold, because we did see the typical inverse relationship kind of built up again to some extent this week between gold and the dollar, at least, yes, after the ECB move.
And that is generally also reflected, the correlation is generally reflected on the gold market as well. It's very much played a dual personality between risk asset and safe haven asset. And probably most notably, it has been the risk market, so it has traded alongside euro-dollar on the downside. Right now, the key levels to watch out for on gold are 1641 on the upside, so that would suggest maybe some upside pressure coming in. But my cycle studies suggest a potential breakdown into the 1522 area, and that would offer maybe a dramatic move into 1417, 1300. I'm expecting some seasonal volatility in the month of July and onwards, so that will probably trigger further downside pressure on the gold market.
Okay. Fantastic. Ron, pleasure having you in the studio, face to face. It makes a difference versus doing it down the line all the time. So, Ron, thank you. Ron William, independent market strategist.